Hey everyone, and welcome back to Financial Essentials. Let's talk about something that gets a really bad rap: debt. The word itself can make you feel a little anxious, right? We're often told to avoid it at all costs. But here's the thing: not all debt is created equal. Some debt can actually be a powerful tool to build your wealth and get ahead in life. On the flip side, other types of debt can sneakily eat away at your future income, trapping you in a cycle that's hard to escape. So, how do you tell the difference? How do you borrow smarter and avoid those financial pitfalls? Today, we're going to break down the world of good debt versus bad debt, giving you a clear roadmap to make debt work for you, not against you. This is a crucial topic, so grab a notepad and let's dive in. First up, what exactly is debt? It sounds simple, but let's get on the same page. At its core, debt is just money you borrow with a promise to pay it back later. But there's a catch, and its name is interest. Interest is the fee you pay for the privilege of borrowing that money. Think of it as the rental cost for cash. The higher the interest rate, the more expensive that debt becomes over time. A small loan can balloon into a huge financial burden if the interest rate is high enough. This concept is the key to understanding everything else we're going to talk about today. It's not just about the amount you borrow. It's about the total cost of that borrowing. Forgetting about interest is one of the biggest mistakes people make. They focus on the shiny new thing they can get right now, without calculating what it will truly cost them by the time they've paid it all back. So, whenever you think about taking on debt, the first question you should ask is, what's the interest rate? Now, let's get to the good stuff literally. What is good debt? Good debt is an investment in yourself and your future. It's borrowing money to acquire something that will either increase in value or increase your ability to earn more money down the road. Essentially, it helps grow your net worth. Good debt typically has a few key characteristics. First, it's used to buy an asset that appreciates or generates income. Second, it usually comes with a lower, more manageable interest rate. So, what are some real-world examples? A student loan for a degree that leads to a high-paying career is a classic one. You're investing in your skills to dramatically increase your future earning potential. Another great example is a mortgage on an affordable home. Over time, that house will likely increase in value and you're building equity with every payment. Instead of paying rent to a landlord, you're paying yourself. Finally, a business loan used to start or expand a company that generates profit is also good debt. In all these cases, the debt is a strategic tool to build long-term wealth. Alright, let's flip the coin and talk about bad debt. If good debt builds you up, bad debt tears you down. Bad debt is typically used to buy things that lose value the moment you buy them. These are called depreciating assets. It often fuels impulse spending and instant gratification rather than long-term goals. The most dangerous feature of bad debt? It almost always comes with a sky-high interest rate, which can keep you trapped for years. The most common example is high-interest credit card debt. When you carry a balance month after month on a credit card, the interest charges can be brutal, making that small purchase cost you double or even triple its original price over time. Another one is payday loans, which are notorious for their predatory interest rates that can create a devastating debt spiral. Even car loans can be bad debt, especially for expensive, luxury vehicles that lose a huge chunk of their value as soon as you drive them off the lot. And we have to talk about the rise of buy now, pay later services. While they can be useful, they make it incredibly easy to overspend on things you don't need, racking up debt without even realizing it. Bad debt buys you temporary satisfaction at the cost of your long-term financial freedom. Let's really hammer this home. Interest changes everything. The difference between a 5% interest rate and a 20% interest rate is the difference between a manageable tool and a financial disaster. Imagine you buy a $1,000 TV. If you put it on a credit card with a 20% interest rate and only make minimum payments, it could take you years to pay off, and you might end up paying nearly $2,000 in total. That TV wasn't really $1,000, was it? Now compare that to a mortgage. A $300,000 home loan at a 5% interest rate is a huge amount of money, but the low rate makes the monthly payments manageable for many people. Plus, the house is an asset that's likely growing in value. This is why you have to stop focusing only on the monthly payment. Lenders love to advertise low monthly payments because it makes expensive things seem affordable. But you have to be smarter than that. Always calculate the total cost of the item, including all the interest you'll pay over the life of the loan. When you see that total number, you might think twice about whether that purchase is truly worth it. So you might have a mix of both good and bad debt. What's the game plan? How do you handle it all? The strategy is simple. Attack your high-interest bad debt first with everything you've got. This is what's actively costing you the most money and holding you back. Make a list of all your debts and sort them by interest rate, from highest to lowest. Throw every extra dollar you can find at that top of the list debt until it's gone. This is often called the debt avalanche method. While you're doing that, it's crucial to build up an emergency savings fund. This prevents you from having to rely on a credit card when an unexpected expense pops up, which would just add more bad debt to your plate. Look into refinancing options. If you have a high-interest loan but your credit has improved, you might be able to refinance to a lower rate, saving you a ton of money. And most importantly, commit to not adding any new bad debt. Start using your credit cards intentionally, like a tool to be paid off in full every single month, not as a source of extra cash. Now, let's bust a few common debt myths that keep people stuck. Myth number 1, all debt is evil. We've already shown that's not true. Strategic debt like a mortgage or a business loan can be a launchpad for wealth. Myth number 2, you should never borrow money for anything. Again, this is too simplistic. Refusing to borrow for a valuable education or a home could actually set you back financially in the long run. And the biggest myth of all, as long as I can afford the monthly payments, I'm fine. This is incredibly dangerous thinking. It ignores the total cost of interest and can lead you to being house poor or car poor, where payments eat up so much of your income that you have no room for anything else. The truth is, your strategy matters far more than your emotions about debt. A smart, calculated approach will always beat a fearful, avoidant one. Okay, let's put it all together. Here's your actionable debt game plan, starting today. Step 1. Make a comprehensive list of every single debt you have. Include the balance, the interest rate, and the minimum monthly payment. Step 2. Sort that list by interest rate, highest to lowest. This is your battle plan. Step 3. Automate your minimum payments on all debts so you never miss one. Then focus all your extra money on the debt at the top of your list. Step 4. Look for ways to increase your income even just a little. Every extra dollar thrown at your high-interest debt accelerates your progress. And step 5. Celebrate the milestones. When you pay off a card or a loan, acknowledge that victory. It'll keep you motivated for the journey ahead. At the end of the day, debt itself isn't the enemy. A bad strategy is. Understanding the difference between good and bad debt gives you the power to make informed choices that align with your long-term goals. It's about turning a potential burden into a powerful tool for building the life you want. Thanks so much for tuning in to Financial Essentials. If you want more practical tips for building smarter money systems, make sure you subscribe to the channel. We'll see you in the next video.